Welcome back to the deep dive. Today it's kind of like having a Wall Street insider in your pocket because we're taking a look at this article from the Motley Fool, and it's about three S&P 500 stocks that are down. Get this, 27%, 28%, and 29%. Now, I don't know about you, but when I see numbers like that, well, it makes me a little nervous, but also kind of excited. Like, is this a sign of trouble? Or is this a chance to get in on some hidden gems?
Yeah, big drops can definitely be a bit of a head scratcher. Could be a sign of trouble brewing or, like you said, a golden opportunity. Depends on what you're looking for, right?
For sure. And that's what we're going to try to figure out today. The Motley Fool calls these stocks potential forever holds, but we're going to, really get into it, see if they really live up to that hype. What do you think?
Sounds like a plan. Let's break it down.
All right. So first up, we've got Verizon, ticker symbol VZ. Okay. I feel like everyone's heard of Verizon, right? It's like practically a household name at this point. But is it just a boring old telecom giant, or is there something more to the story?
Well, they're definitely known for their mobile phone service. But what's really interesting is how they're leveraging their network for this whole other side of the business, their institutional business.
Yeah, now that you mention it, I have heard something about that. What exactly are they doing with businesses?
So basically, they're not just providing cell phone plans. They're actually building like the digital backbone for entire industries.
Whoa, okay. So, what does that actually look like?
Think 5G networks that are custom designed for businesses, edge computing to process data right there on the spot. They're even helping companies like utility companies manage smart grids and car companies with their connected vehicles.
Whoa, okay. So they're not just sending data, they're becoming the brains behind how all that data gets used.
Exactly. And a key part of that is their huge fiber optic network. I mean, since 2020 alone, they've put down almost 57,000 miles of fiber. Crazy when you think about it.
It's a lot of fiber.
It is. And it's a big deal because as more and more devices come online, data usage is just going to explode. So those fiber optic cables, they're like the information superhighways of the future.
That's a good point. But I'm still kind of stuck on this stock drop. If they're doing all these innovative things, why is Verizon down 28% from its peak? Is the market missing something here?
It's a good question. Remember, the market is always looking ahead. So some investors might be worried that even with these new ventures, Verizon's overall growth might be limited. On the other hand, that 28% drop has pushed their dividend yield up to a pretty nice 6.3%.
Okay, yeah, 6.3%. That's not bad at all. So I guess it comes down to, what kind of investor you are, right? Are you looking for that potential high growth, maybe a little more risky, or do you prefer that steady, reliable income?
Right, and that's actually a key question for anyone looking at Verizon, but really all three of these companies.
Good point. Okay, let's move on to our next contender, Realty Income, ticker symbol O. Actually, I've heard some good things about this company, mainly because their dividend track record is just mind-blowing. I mean, they've increased their payouts for 108 straight quarters, and get this, they pay them monthly.
They're definitely in a league of their own when it comes to consistency. And a lot of that success comes from their specific niche in real estate, strip malls and big box stores.
Wait, so in the age of the retail apocalypse, they're betting on brick and mortar. Isn't that a little counterintuitive? I mean, shouldn't we all be investing in online everything these days?
It might seem that way, but Realty Income has a clever approach. First off, they target those retailers that are less vulnerable to e-commerce, like your Dollar Generals, Dollar Trees, Walmart.
Oh, so those stores where you can still score some amazing deals. It's true. I mean, I still got to go out for those sometimes. Even with online shopping, people still need to buy groceries, household stuff,
Exactly. And secondly, Realty Income uses a certain type of lease. It's called a triple net lease. Basically, the tenant pays for property taxes, insurance, even building maintenance.
So Realty Income is pretty hands-off.
Pretty much. And that means their income is super stable and predictable, even when the economy takes a hit.
Okay, so they're not just picking random retail spaces. They're being very strategic about it. But does it actually work? Do they have the numbers to back it up?
Oh, yeah. Their occupancy rate is a whopping 98.7%. Even during the whole pandemic, when most retail REITs were struggling, Realty Income held strong at 97.9%.
Wow, that's impressive. Okay, so their name, Realty Income, really checks out. They seem to really prioritize steady income for their investors. Oh, before we move on, you mentioned Realty Income is a REIT. Could you quickly explain what that means for anyone who's not familiar with the term?
Sure thing. REIT stands for Real Estate Investment Trust. Basically, it's a company that owns and operates income-producing real estate. And the thing about REITs is that they're required to distribute at least 90% of their taxable income to shareholders as dividends, which is why they tend to have those higher dividend yields compared to other companies.
Oh, that makes sense. So yeah, if you're looking for steady income, REITs like Realty Income might be worth a closer look. All right, last one for today. Bristol-Myers Squibb, ticker symbol BMY. Okay, I gotta be honest, I don't think I can name a single drug they make. Is that a bad sign? Are they intentionally flying under the radar?
It's actually a very deliberate strategy. Instead of chasing after those big blockbuster drugs, Bristol-Myers Squibb has built this diverse portfolio so they're not relying too heavily on any single product.
Oh, so it's like not putting all your eggs in one basket, spreading the risk around. Makes sense from a stability standpoint, but how do they grow? How do they innovate if they're not going after those big name drugs?
Well, they're really good at acquisitions and partnerships. So, for example, Eliquis, the blood thinner, came to them through a collaboration with Pfizer, and now it's one of their top earners. They're basically bringing in those proven winners and adding them to their portfolio.
Ah, so they're letting other companies take on the initial risk and then swooping in once a drug shows promise. It's like a strategic shortcut to growth.
You could say that, but there's a reason their stock is down 27%. Partly it's because their sales haven't been growing as fast as some investors hoped, and they've been spending a lot on those acquisitions.
So investors are a bit impatient, even though the long-term potential might be there. There's got to be another side to this story, though, right? Like, why else would the Motley Fool include them in this list of forever hold stocks?
You're reading my mind. They see these acquisitions as essential for their long-term growth, and they've got the track record to back it up. I mean, they've increased their dividend for 15 years straight. Clearly, they're committed to rewarding shareholders while still investing heavily in the future.
Okay, so they're trying to strike that balance between growth and rewarding their investors. So far, these companies all sound intriguing, but I'm also hearing about some potential downsides. I think this is where things start to get interesting.
Absolutely. It's all about weighing the risks and the rewards, and that's what we'll dive into even deeper in the second part of our deep dive. It really is amazing how each of these companies has, like, a totally different approach.
Yeah.
Like they're all playing the market in their own unique way.
Yeah, it's fascinating. And it's interesting how they're all down so much from their highs. I mean, that's kind of what got us talking about them in the first place, right?
Oh, for sure. I mean, when you see a stock drop 20% or more, it definitely makes you wonder what's going on.
Exactly. Like, is this a fire sale or a sign that something's seriously wrong?
That's the million-dollar question.
Yeah.
And remember, the market is always thinking ahead, right? It's not just reacting to what's happening right now. It's trying to predict what's going to happen in the future.
Yeah. So even though these companies seem to have a lot going for them, there might be some warning signs that we need to pay attention to, right?
Exactly. Like maybe there are some challenges on the horizon that investors are already picking up on.
Okay, so let's put on our detective hats and see if we can spot any red flags. Let's start with Verizon. They seem to be making some smart moves with their, what was it called? Their institutional business and their fiber optic network. But what are some of the challenges they might be facing?
Well, even with all their fancy technology, they can't escape the fact that the telecom industry is super competitive. I mean, you've got T-Mobile, AT&T, they're all fighting for the same customers.
So even though they're building out this amazing infrastructure, they still have to worry about keeping their customers happy and attracting new ones.
Exactly. They can't afford to get complacent, They need to be constantly innovating, offering competitive prices, providing excellent customer service, the whole 9 yards.
Okay, that makes sense. What about Realty Income? They seem to be doing pretty well with their focus on essential retail, but are there any risks we should be aware of?
Well, the elephant in the room is definitely e-commerce, right? Even though they've been really careful about choosing tenants that are less vulnerable to online shopping, there's always a chance that e-commerce could, take an even bigger bite out of traditional retail.
Right, like what if everyone suddenly decides to buy everything online, even groceries and household stuff?
Exactly. And if that happens, even Realty Income's most reliable tenants might start to see a decline in foot traffic, which could hurt their sales and ultimately impact their ability to pay rent.
And if their tenants are struggling, that means Realty Income's rental income could take a hit, right?
Yeah.
And that could put their dividends at risk.
Exactly. So it's definitely something investors need to keep an eye on. How's the e-commerce landscape changing? And how could that impact Realty Income down the line?
Okay, yeah, good point. All right, last but not least, what about Bristol-Myers Squibb? They seem to have a pretty solid long-term strategy with all their acquisitions and their diverse portfolio, but what are some potential obstacles they might face?
Well, one of the biggest challenges for any pharmaceutical company is the rising cost of drug development. I mean, it's incredibly expensive to bring a new drug to market these days.
So even though they're being strategic about their acquisitions, they still have to be mindful of their bottom line.
Right. They need to make sure they're getting a good return on their investment. And they also have to stay ahead of the curve in terms of research and development. They can't just rely on acquisitions. They need to keep innovating and developing their own new drugs.
And they have to deal with competition from generic drugs, right? Once their patents expire, other companies can start making cheaper versions of their drugs.
Oh, yeah, that's a huge challenge. Generics can really eat into their profits. So it's a constant balancing act for them. They need to make smart acquisitions, invest in R&D, and navigate the competitive landscape.
Okay, so we've talked about the specific challenges each of these companies is facing, but we also need to zoom out a bit and look at the bigger picture, right?
Absolutely. We need to consider those broader trends that could impact the whole stock market and, by extension, these three companies we're talking about.
So what are some of those big picture trends that investors should be paying attention to?
Well, right now, one of the biggest things on everyone's mind is inflation. I mean, the Fed's been raising interest rates like crazy to try and bring it under control, but that can make it harder for companies to borrow money and invest in growth.
Right, because higher interest rates basically mean higher borrowing costs for businesses.
Exactly. And that can slow down the economy, which could lead to lower consumer spending. And that's bad news for companies like Verizon, Realty Income, and Bristol-Myers Squibb, which all rely on consumer spending to some extent.
So it's all connected, right? What happens in the broader economy can have a real impact on individual companies.
Oh, absolutely. It's like a ripple effect. And then there's the whole geopolitical situation, which is always a bit unpredictable. I mean, you've got the war in Ukraine, tensions between the U.S. and China, political instability in different parts of the world. All of that can create uncertainty and volatility in the markets.
It feels like there are a lot of things that could go wrong right now.
There are definitely some risks out there, that's for sure. But that's why it's so important to have a long-term perspective and to focus on the fundamentals.
So we shouldn't get too caught up in the day-to-day ups and downs of the market.
Exactly. We need to look beyond the headlines and focus on those underlying factors that drive a company's long-term success.
Okay, so we've talked about the challenges, the risks, the broader economic and geopolitical landscape. But the big question remains, are these stocks actually worth buying?
That's the question everyone wants answered. But unfortunately, there's no easy answer. Investing is not a one-size-fits-all kind of thing.
So there's no magic formula or secret sauce that can tell us which stocks are going to go up.
I wish there was. But the truth is, what's right for one investor might be totally wrong for another. It all depends on your individual circumstances, your financial goals, your risk tolerance.
So even though we've done all this analysis and learned a lot about these companies, the ultimate decision of whether or not to invest is up to each individual listener.
Exactly. Our job is to provide you with the information and the tools you need to make informed decisions. But the final call is always yours.
And that's why it's so important to do your own research, understand the risks involved, and only invest what you can afford to lose.
Couldn't have said it better myself. And remember, we're not financial advisors, so we're not giving specific investment recommendations. Our goal is to empower you to become a better investor.
Right, to give you the knowledge and the confidence to make your own decisions.
Exactly. Because knowledge is power, especially when it comes to investing. And in today's world, there's so much information out there, it can be really overwhelming.
I know. There's so much jargon, so many different opinions, it's hard to know where to even start.
That's where the deep dive comes in. We try to take those complex topics, break them down into bite-sized pieces, and make them accessible to everyone.
And we try to have some fun along the way.
Oh, definitely. Because investing shouldn't be boring or intimidating. It should be exciting.
I totally agree. Okay, so we've covered a lot of ground today. We've talked about Verizon, Realty Income, and Bristol-Myers Squibb, their strengths, their weaknesses, the challenges they face, the broader market trends that could impact them. We've also stressed the importance of doing your own research and making sure any investment aligns with your own goals and risk tolerance. But before we wrap things up, there's one more important concept I want to touch on.
I think I know where you're going with this. Moats.
You got it. But for anyone who's not familiar with that term, can you explain what moats are and why they're so important for investors, especially those looking for long-term holds?
Absolutely. A moat in the business world It refers to a company's competitive advantage. It's that special something that sets them apart from their rivals and makes it hard for new competitors to enter the market.
So it's like a protective barrier that helps a company maintain its profitability and its market share over the long term.
Exactly. It's like a castle with a moat around it. Makes it a lot harder for enemies to attack, right?
And when we're talking about buy and hold forever stocks, like the ones we've been discussing today, the concept of moats becomes even more crucial.
For sure. If you're going to hold a stock for years or even decades, you want to make sure it has that sustainable competitive advantage, something that'll help it thrive even as the world changes around it.
So it's not just about how a company is performing today, it's about their ability to adapt and stay ahead of the curve in the future.
Precisely. And that's why I always encourage investors to think about the moats of the companies they're considering. What makes them resilient? What sets them apart? What gives them that edge that's likely to last?
That's a great challenge for our listeners to think about. It's not enough to just look at the numbers. We need to understand the underlying forces that are driving those numbers. We need to think like business owners, not just stock pickers.
Couldn't agree more. And that kind of thinking, that's what separates the good investors from the great investors.
Okay, so with that challenge in mind, let's move on to the final part of our deep dive and see if we can identify those moats that might make these companies worth considering for the long haul. Okay, so let's dig into these moats. What makes these companies special? What gives them that edge?
All right, let's start with Verizon. For me, their moat is pretty obvious.
Yeah.
It's their massive infrastructure. I mean, that nationwide 5G network, their crazy extensive fiber optic network, it gives them a huge advantage when it comes to speed and reliability.
Yeah, it's not like someone can just pop up and build a network like that overnight, right?
Exactly. I mean, you're talking billions of dollars and years of work to even come close to what Verizon has already built. It's a huge barrier to entry for any competitor.
And it's not just about the physical infrastructure either, right? It's about the knowledge and expertise they've built up over the years, knowing how to build and manage these complex networks.
Oh, absolutely. They've been at the forefront of the telecom industry for decades, so they've got that experience, that know-how, that's hard to replicate.
Okay, so yeah, I think we can agree that Verizon has a pretty strong moat when it comes to their infrastructure. But what about Realty Income? What sets them apart in the world of real estate?
For Realty Income, it's all about focus. They've really zeroed in on this specific niche, essential retail properties that are less likely to be affected by, the whole e-commerce thing.
Right, so they're not trying to be everything to everyone. They're being super strategic about the types of properties they buy and the tenants they choose.
Exactly. They've basically chosen to be the best in a smaller pond, rather than trying to compete in the vast ocean of all real estate. And that specialization has given them a depth of knowledge and a network of relationships that's really hard to match.
And they've also structured their leases in a way that gives them this really stable and predictable income stream, right?
Oh yeah, they've thought of everything, from tenant selection to the terms of their leases, even down to property management. It's a very well-oiled machine.
Okay, so Realty Income's moat is about focus, expertise, and a rock-solid business model. That's impressive. But what about Bristol-Myers Squibb? I mean, their strategy seems a bit more, complex. What's their moat?
You're right. Their approach is definitely more nuanced. I'd say their moat is a combination of things. A diversified drug portfolio, a history of making smart acquisitions, and strong relationships with healthcare providers.
So they're spreading their risk, they're not relying on any one blockbuster drug, and they're making sure their products are getting into the hands of the people who need them.
Exactly. And don't forget their commitment to research and development. They're constantly investing in new drugs and technologies, which helps them stay ahead of the game.
So it's like they're playing both offense and defense, acquiring proven winners while also developing their own innovative products.
Exactly. It's a smart strategy, especially in an industry that's as competitive and fast-moving as pharmaceuticals.
Okay, so it sounds like all three of these companies have built some pretty solid moats. That's definitely a good sign if we're thinking about them as, those long-term, forever hold investments.
It definitely is. Of course, a wide moat doesn't guarantee success, but it certainly increases the odds of a company performing well over the long haul.
Well, there you have it. We've taken a deep dive into Verizon, Realty Income, and Bristol-Myers Squibb. We've talked about their strengths, their weaknesses, the challenges they face, and those all-important moats. But remember, the decision of whether or not to invest is ultimately up to you.
Exactly. We've given you the information, the insights, but you need to do your own research Consider your own financial goals and make sure any investment fits your risk tolerance.
We're not financial advisors, so this isn't investment advice. It's all about empowering you to be a smarter investor.
Investing is a journey, not a destination, right? Keep learning, keep asking questions, and most importantly, keep investing in yourself.
Couldn't have said it better myself. Thanks for joining us on the deep dive, everyone. We'll catch you next time for another exciting exploration of the world of finance and investing. Until then, happy investing.